This Chapter 5 examines the use of total return swaps on an issuer's own equity to generate funding for the issuer in a cost-efficient and leverage-friendly manner. The principal application illustrated in this chapter is quite controversial, and upon disclosure has embarrassed those who used it in particularly aggressive ways. Our illustration of the own equity total return swap structure begins with an over-leveraged issuer who seeks $100 million in 5-year funding when his stock price is trading at 100 spot. The issuer sells 1 million shares to a friendly dealer, then simultaneously enters a total return swap with the same dealer, whose terms are described next. First, on each dividend payment date, the dealer must pay to the issuer an amount equal to the dividend rate on the stock multiplied by 1 million. Second, on periodic dates specified in the confirmation, the issuer must pay to the dealer an amount equal to $100 million times LIBOR plus a spread, adjusted of course for the day count. And third, on the swap termination date, the spot price of the stock is multiplied by 1 million and then subtracted from $100 million. If this amount is positive, the issuer pays it in cash to the dealer, while if it is negative, the dealer pays the inverse in cash to the issuer. After a moment of thought, you should recognize that the last part of the confirmation shifts all upside and downside from the stock back to the issuer, even though the dealer is the legal owner of the shares. You should also recognize that on a net basis, the issuer does not pay, nor the dealer receive, dividends on the 1 million shares. And finally, you should recognize that the dealer has received interest at LIBOR plus the spread on an aggregate exposure of $100 million under the transaction. The package of transactions as a whole therefore resembles economically an extension of credit to the issuer priced at LIBOR plus the spread, but for which the accounting is presumably quite different. First, the sale of shares on day one would be recognized on the balance sheet as a capital increase, reducing the issuer's leverage ratios and improving other measures of creditworthiness. Second, basic EPS is immediately affected by the dilution caused by the sale of shares, but this may be the lesser of the issuer's worries, its leverage being of greater concern. Third, the fair value at inception of the TRS is 0. So neither an asset nor a liability is recognized on the issuer's balance sheet on account of the swap. Fourth, subsequent swings in the share price will pull the swap fair value up and down and will be recorded in the income statement, generating significant earnings volatility for the issuer. And fifth, to eliminate dilution on the termination date, the parties can presumably agree that the dealer will offer the shares at their market price to the issuer if the issuer wishes to repurchase them. This is something the issuer can do anyway via the secondary market, but a direct purchase from the dealer reduces or eliminates the bid-offer spread. The trade-off facing the issuer under this transaction is between the improvement in its leverage ratio and the EPS dilution and income statement volatility it generates. The former may not be that significant if the proceeds from the sale of shares are deployed in activities that permit earnings after tax to grow by an amount sufficient to offset the increase in the denominator of the EPS calculation. The latter is a more serious problem, however, especially if the transaction represents a substantial percentage of the issuer's total equity and if the volatility of its shares is high. Assuming very crudely that the company's PE ratio is 20, which implies that net income is 5% of market capitalization, and also that the size of the transaction is 10% of current market capitalization. A 25% decline in the spot price of the shares would wipe out half the company's earnings for the year, ignoring tax effects and other matters of a secondary order of materiality. We note also that a sharp decline in the issuer's stock price would be generating losses for the issuer, precisely when its performance presumably is suffering in general, as reflected by the fall in the stock. Poor operating results would be compounded by the loss on the total return swap, although the reverse would be true also when performance is solid, the stock price is soaring, and the gain under the TRS amplifies the company's reported earnings even further. This may explain why transactions of this kind have lost favor since the advent of IAS 39, and particularly the need to record changes in the TRS fair value through the income statement. They continue to have appeal, however, to issuers in jurisdictions that have not adopted IFRS, especially if the local accounting rules permit accrual accounting for the TRS. It may be asked why the issuer does not neutralize the income statement volatility by using, instead of the cash-settled total return swap, an instrument with gross physical delivery, such as a physically settled 5-year forward purchase of the shares it has sold on day one to the dealer. The problem is that while this would address the income statement issue, it also nullifies the desired accounting benefit. We saw in Chapter 2 that under this mode of settlement, equity would be reduced on day one by the full $100 million notional of the transaction, and a liability would be recognized immediately for the same amount, in effect replicating almost exactly the accounting that the issuer would have achieved if it had simply issued debt. The one remaining benefit may be that the liability, in this case, is recognized, as we have seen, as a derivative liability and not simply as debt. This may generate benefits from the perspective of the issuer's loan covenants. This completes this Chapter 5 and brings us to the quiz.